The dot-com bust, the 2008 crisis, the 2020 flash crash. In every single one of these events, while the majority panicked and sold, I made millions every time. I didn't have inside information. I didn't have a crystal ball. I just had a different playbook. I'm opening up my entire strategy today, but the market moves fast. Subscribe to the channel so you're always locked into the same data and logic I'm using to navigate these crashes in real time. While everyone else was seeing risk, I was seeing a fire sale. Today, I'm going to show you that playbook. I'm not talking about surviving a crash. I am talking about how to position yourself so that when the market breaks, you win. I'm going to walk you through exactly how I prepare for the drop. The stuff that feels terrifying in the moment, but pays off for decades. No crap talks, just strategy. First, let's get something straight. Markets don't just go up forever. That is a fairy tale we tell ourselves during bull markets so we can sleep at night. If you invest long enough, you are going to meet 3 specific kinds of drops. The first is a correction. This is about 10% down. These happen all the time, every year or so. It's the market taking a breath, like someone realizing they ate too much dessert and deciding to skip dinner. It's healthy. But even these can feel scary if you're new. You see a few $1,000s vanish and you think, is this the start of the big one? Usually, it's just noise. The second is a bear market, down 20% or more. These are different beasts. They stick around. They don't just flash and disappear. They linger for months, sometimes close to a year or more. They feel heavy. The headlines get darker. Your friends, the ones who were bragging about their gains 6 months ago, they stop talking about stocks entirely. The group chat goes silent. The third is the one people really fear, the collapse, 30, 40, 50% down. It happens fast or it happens in a grinding, painful slide. This is rare, but when it happens, everything feels fragile. It's not just about stock prices anymore. People start worrying about their jobs, their homes, the banking system itself. Confidence evaporates overnight. Here's the truth nobody likes to hear, and I'm going to say it because I wish someone had said it to me in the 90s. If you can't emotionally handle markets going down sometimes, the stock market is not for you. And that's not an insult, it's just honesty. If you panic sell every time the graph turns red, you are essentially paying a premium to lose money. Now let me show you how these crashes actually unfold, because they follow a pattern every single time. It's the same 3-act play performed by different actors. Phase 1 is what I call the euphoria phase. This is when everything feels easy. Too easy. People are smiling, money feels loose. Everyone suddenly has an opinion about investing. You hear phrases like, this time is different, or stocks only go up, or you can't lose on this. I remember the lead-up to the dot-com crash in the late 90s. I was younger then, and I remember feeling like an absolute idiot for owning boring companies that made actual profits. I had friends buying companies that were just a website and a logo, making 50% returns in a month. I felt like I was missing out on the party of the century. Then came the lead-up to 2008. That was different, but the smell was the same. I noticed little things. Restaurants were packed on Tuesday nights. Steakhouses where a dinner cost $200, filled with people I knew weren't making that kind of money. People were refinancing homes like their house was an ATM machine. Guys who'd never opened a brokerage account were suddenly real estate investors flipping condos in Florida they'd never even visited. Years later, I saw the exact same energy with crypto and NFTs. Regular people, good, hard-working people, paying insane money for digital pictures of monkeys or coins named after dogs. Not because they believed in the value, not because they understood the utility, but because the price kept going up. That's always the giveaway. When excitement replaces caution, I start getting nervous. When the taxi driver, the barber, and my cousin who usually asks me for money start giving me stock tips, that is the signal. Not scared, prepared. Back then, I didn't announce it. I didn't make a big speech on Facebook. I just quietly started changing how I invested. I stopped chasing the winners. I looked at my portfolio and asked, if the market shuts down tomorrow for 5 years, would I still want to own this? If the answer was no, I sold it. I reduced risk. I took my foot off the gas. I built cash. Some friends thought I'd lost my edge. A couple even joked that I was getting soft, acting like an old man. Sam, you're missing out on the rally. What they didn't see was what I was protecting. I wasn't protecting my gains. I was protecting my sanity for what was coming next. Because phase 2 always comes next. I call it the reckoning. This is when reality shows up without knocking, and it kicks the door in. Prices drop, then they drop again. The buy the dip crowd gets excited at first. They buy the first 5% drop. Then it drops another 10%. Then the news turns ugly. Fraud is uncovered, banks fail, companies miss earnings, people stop checking their accounts because it hurts too much to look. Or worse, they check them obsessively, 5 times an hour, watching their net worth tick down in real time. Sleep gets worse. Arguments with spouses go up. The atmosphere changes. I'll never forget 2008. My son was 10 years old then. Even he could tell something was wrong. I owned a small retail business at the time. My stores, they just went quiet. It was eerie. The phone stopped ringing. Foot traffic vanished. Customers who did come in walked differently. Shoulders hunched, browsing like they were killing time, not buying anything. I remember standing in my store, looking at the inventory I'd paid for, wondering if anyone would ever buy it. But here's the strange part. I was calm. I wasn't calm because I was fearless. I wasn't calm because I knew where the bottom was. I was calm because I had prepared during phase 1. I had inventory. I had cash in the bank. I wasn't over-leveraged. I didn't owe money I couldn't pay back if business slowed down for 6 months. That mattered more than any stock pick I've ever made. Most people say they are long-term investors. It's easy to be a long-term investor when the line is green. But when your portfolio gets cut in half, that is when your beliefs get tested. That is when you find out who you really are. This is where understanding what you own becomes everything. If you bought a stock just because it was going up, you have no anchor. When it drops 30%, you have no reason to hold it other than hope, and hope is not an investment strategy. If you don't know why you bought something, how will you know when to hold it when the world feels like it's burning? I watched friends sell great businesses, companies like Apple, Amazon, Microsoft, at terrible prices just to make the pain stop. They sold because they couldn't take the emotional pressure anymore. They wanted the anxiety to end. A few months or years later, those same stocks started climbing. Then they soared. The regret of selling at the bottom stuck around much longer than the loss would have. So what did I do? I didn't try to be clever. I didn't try to catch the exact bottom. Only liars catch the exact bottom. I bought slowly. Every week, I had a list of companies I loved, companies with cash, good products, vital services, and as their prices got decimated, I bought them. Small amounts, $500 here, $1,000 there. And you know what? Usually right after I bought them, they dropped another 10%. It felt terrible. It felt like throwing money into a fire, but I kept doing it. Cash is power in this phase. Not excitement, not confidence. Cash. If you have cash during a crash, you are the boss. You are the liquidity provider for everyone else's panic. That's why I always say boring habits save you when exciting markets break. Living below your means in the good times is the only reason you have ammo in the bad times. And then, quietly, almost without permission, phase 3 begins. The Phoenix phase. Here's the tricky part about recoveries. It never feels obvious when it starts. There's no bell ringing. The president doesn't come on TV and say, "Okay, folks, clear to buy stocks now." The news is usually still terrible when the market turns. Headlines are still talking about recession, unemployment, and doom, but the market sniffs out the future before we do. Just small signs. Hiring picks up a little. Businesses reopen. People start planning vacations again. After 2008, it took years. It was a slow grind, longer than most expected. But when the recovery came, it didn't just return to old highs, it blew past them. The people who waited for the perfect time to get back in, they missed the first 20% of the rally. Then they waited for a pullback that never came. Then they ended up buying back in at the top years later. I've seen this cycle over and over. Black Monday in '87, the dot-com bust in 2000, the financial crisis in '08, the pandemic in '20. Different headlines, different triggers, same human behavior. Fear creates the discounts. Patience collects them. The biggest lesson I've learned, the one that cost me thousands of dollars to figure out, is simple. The money you make in bull markets is obvious. It feels good. It pays for the nice dinners. But the money that changes your life? The wealth that lets you retire early or pay for your kids' college without sweating? That money is usually planted during chaos. It happens in the months when everyone tells you you're crazy to be buying stocks. It happens when you look at your bank statement and feel a knot in your stomach, but you click transfer anyway. But you can only do that if you follow the rules of survival. Number 1, stay diversified. Don't bet the farm on one horse. I've seen sure things go to zero. Number 2, no leverage. If you don't trade on margin, they can't force you to sell. If you can't be forced to sell, you can wait out any storm. Number 3, discipline with memory. Remember that the world didn't end last time. It won't end this time. That's not bravery. I'm not a brave man when it comes to money. I hate losing it. That's just discipline with memory. I've made mistakes. I've chased things I shouldn't have. I've sold too early. I've held too long. I have bought high and sold low more times than I care to admit. But I have never regretted staying invested through fear. I have never regretted betting on the resilience of the human economy. If you're watching this and feeling anxious about the market right now, take a breath. You have time. If you want, you can check my video about starting and building an investing plan step by step, the boring, unsexy, effective way. I've put that video together a month ago, but don't click away just yet. Sit with this first. Check your emotions. Are you being greedy or are you terrified? Because the next crash will come. It is mathematical certainty. And when it does, the question won't be whether you saw it coming. The question won't be if you predicted the exact date. It'll be whether you're ready to stand still when everyone else is running. I'm Sam. I've made the mistakes so you don't have to. Subscribe and hit that bell icon so you can stay away from the mistakes that I have made in the past. Thanks for watching.